All right, everybody, welcome to another episode of Capitalize on Retirement. Here today, we are going to do our Q2 market recap and what's ahead. And we're kind of going to start this off with, obviously a recap of our quarter one and kind of what we assumed, what was happening, what was going on. And then we'll kind of get into quarter two. So you want to start us off with a quick quarter one recap?
Yeah. So, quarter one didn't look as good, right? I mean, when we were looking at this in the first quarter, we have the numbers right here, but the Nasdaq was down roughly 7%. S&P was down 4 to 5%. Dow was down as well. And we had 3 straight years of 15+% returns. So in that episode, we were saying, with that many good years in a row, it's very likely that we see market pullbacks, which is exactly what happened in the first quarter.
Yeah, and I don't think that came as too much of a surprise. There was a lot going on. I mean, the government was on a 43-day shutdown.
Yeah.
There was Fed uncertainty. There's still Fed uncertainty. And then obviously the early Iran-related oil jitters. So we did see some fogginess in the market.
Yeah, we actually talked about that. We said, it's like driving down the road and, seeing fog. Well, when you see fog, you kind of slow down, you pump the brakes. That's what the market did. And the fog kind of cleared out and the market opened up full steam for the second quarter.
Even by the time we did that recording, it was on April 15th. It was on tax day. 'Cause I remember we talked about that.
Yeah.
The S&P already flipped positive by that time. So, Q1 was kind of a scary feeling, but today we're going to grade ourselves on Q2. What were our assumptions? How do we do? And then we'll talk about what we anticipate coming. So heading into Q2, the market is a little nervous again.
Yeah.
We still have the oil and Iran risk. Fed still uncertain. We don't know if they're going to hold rates, if they're going to keep them high. Inflation still a bit stubborn, but there's still strong earnings out there, which kept the market resilient. So do you want to hit our numbers for Q2 and what we saw?
Yeah, let me hit. So I'll hit the Iran stuff first, and just why oil, has such an impact on the market. And I don't think people really understand the impact that oil has on the market. So as oil prices rise because of all the uncertainty in the Middle East, what happens is we pay more for energy costs.
Mm-hmm.
So truck drivers pay more for diesel costs to get us the stuff that we need on a day-to-day basis. We pay more for those items. So as oil prices rise, it's not just we pay more for our gas when we go to the gas tank. We pay more for everything, right? So energy prices impact absolutely everything. And what happens is, let's just say we own a pizza shop. If our costs go up and we're not selling more pizzas, well, what happens is we have less profit. So that hurts our business, right? And that's what happens when oil prices go up. So I think that's what people are worried about. As oil prices go up, is it going to impact our bottom line?
And the answer is usually yes, because it does. As costs go up for everything, that cost either gets passed to the consumer,
right,
or the business owner and the employees take a hit, which doesn't help the economy.
Yeah, and in the short term, companies sometimes that impacts them, but longer term, they're going to pass that off to us, which that's where inflation comes from. So I just kind of wanted to give that quick background. I think people have a hard time understanding why energy prices really impact all parts of the economy.
And that's been very volatile, right? We've seen oil prices up to 118 a barrel. They've come down to 70. So, I mean, we've seen them all over the board. And a lot of that is what we talked about in Q1, that Strait of Hormuz issue. So we're still having that.
Yeah, it seems like every time Trump comes on or somebody comes on and says, hey, we're done with the war, oil prices go down, and then we go back in and oil prices go up. So I think it's going to be something where it keeps kind of bouncing around for the time being, at least.
Oh, yeah. Yeah, I think that's going to remain consistent, whether we want it to or not, but it'll be here. Same thing with the Fed. I mean, we talked about the Feds potentially keeping rates higher for longer, and, I mean, they are more hawkish than we kind of thought.
Yeah.
Right? Like there's a actually rate cut decision today, and at the time of this airing, it's before it comes on, but it doesn't look like they're going to make many changes.
Right. They're either going to stay the same. Some are saying they're going to raise rates, which typically isn't great for the economy overall, but we'll kind of see what happens. So let's go through the numbers for the second quarter. So the Nasdaq in the second quarter was up 21.4% for the quarter. Its best Q2 since 2020.
That was
So
COVID year.
yeah,
So, I
that
mean, a
was
lot
right.
of that, we had that horrible first quarter in 2020. And then
Yeah.
right after that, the market just shot right up.
Yeah, and so the Nasdaq is tech heavy, so you got a lot of the tech names, good earnings, good. So a lot of good things going on with the Nasdaq. S&P was up right about 15%, and the Dow was up right around 13%. So, you know, best Q2 for a lot of these indices in a long time, which was great. And the Russell 2000, which is the smaller cap companies, it was up like 21.2%, best first half for small caps since 1991.
I mean, it's crazy. It's been an incredible quarter. And I think coming off of Q1 and where we were in negative territory, and I think the sentiment around the market then was uncertainty, right? People
Yeah.
were very afraid. And I think if you would have told me we are going to have the best Q2 since 2020 or small cap since 1991, I would have thought you were crazy. I think it kind of comes back to nobody really knows what the market's going to do, but we
Yeah.
know to make money, we have to be in it.
Yeah. We have to have our money invested, right?
Yeah.
If we don't, we're losing to inflation. And so, I think the biggest risk that you run is not being invested, not having your money growing for you.
Yeah, and I think that's why we talk about having a plan all the time. You have to have a plan so that you're going to be able to live out your retirement very successfully. And that plan should allow you to be invested the whole time and deal with the market ups and downs.
Yeah, definitely. So I think with that being said, small caps, I look at, like, a lot of people say, hey, let's track the S&P 500. Let's invest in the S&P 500. A lot of things are kind of balancing out now, right?
Mhm.
You have international coming back. You have small and mid caps coming back and doing pretty well. And I kind of see that as a trend over the next, so many years, just because they've lagged behind for a very long time. So I think obviously we have to stay invested appropriately, but they've just lagged behind for so long.
Yeah, and I think with all these data centers being built right now and the AI run-ups, I mean, I think that's going to continue on because
Yeah.
as they're building these data centers, it's helping every company involved in that. And
Yeah.
there's a ton of I mean, the energy companies, just
Yep.
anybody doing the contract, everything.
Yeah.
Right. So you're seeing big movement out of the sectors just because of these data centers that we're building, and we're going to need them. Like
Yeah.
that's going to continue on.
Yeah. And that kind of goes back to, why has the market done so well over the second quarter? Earnings have been great, right? When companies report good earnings, typically the stock price does well. And so all of these companies are posting great earnings for the most part. And that's why, especially the NASDAQ, those tech companies, they're spending so much right now to kind of build out their infrastructure and really be, top tier moving forward in terms of that space. So, I mean, there's a couple headwinds, but there's a lot of tailwinds going our way as well.
I agree with that. And, we called the direction right at the end of our Q1 episode, and we kind of felt like the market was going to be positive, but, we undersold that a bit. Obviously, the market just absolutely ran up, and that's great. And like you said, there's a lot of tailwinds behind us. There's some headwinds, the Fed, inflation, oil prices, things like that. But I think there's a lot behind us that can keep this steam going.
Yeah, definitely. So let's talk about what's ahead for the rest of 2026. The first one is the Fed and rates. I mean, I think I don't want to call this, but I think rates are probably either going to stay the same or maybe even go up slightly, just because with everything going on right now, with inflation, with the oil prices going up. So we'll see what happens, but I think they're going to kind of stay in that 4 to 4.5% range on the 10-year, maybe tick up a little bit above the 4.5%. So
No, I agree, and I think that's an important number. And inflation has been pretty sticky, so that 10-year Treasury yield is what your typical bonds and annuities are tied to. So when we talk about the income bucket, that's a very important number, and we track that number regularly here. But I don't think we're going to see much change behind there, like you said. I mean, I anticipate the same. Maybe probably stay the same, maybe a little bit of an increase, but nothing too crazy there that should move the markets in a major way.
Yeah, I think inflation and oil is something to look at too. Oil has come off of its wartime highs, but Strait of Hormuz is still kind of fragile.
Mm-hmm.
So I just think we'll kind of see what happens with that. But if we're over there longer and we keep, going through this this Iran war, and the longer we're there, maybe the more prices go up with oil. So we'll kind of see what happens. But I see that as being a big factor in a lot of these things.
I agree, and a lot of that too is headline risk,
Yeah.
right? Because the news outlets publish so much toward that, and oil is, tied to energy, and that's huge for our economy. So it absolutely is a big deal. But a lot of it's headline risk there. So we're kind of going to see what happens there. We could see it easing, but still finishing the year above 3% for
Yeah.
inflation. That is, so we'll see what happens there.
Yeah. The next one's going to be earnings in the market. I think the earnings backdrop that we have is, everything's been pretty good so far this year. I don't know if they're going to be as positive, but I could see it being pretty good for the rest of the year in terms of earnings for a lot of the companies that are, producing earnings here in the next quarter or two.
Yeah, they're talking about double digits, which is kind of unusual for this point in the year, but strength is really concentrated right now.
Yeah.
I mean, it's definitely tilting toward a handful of mega cap and AI names. They're doing a lot of the heavy lifting. So, I mean, that's why direct indexing is so powerful, because you could have more concentrated positions in the ones that are moving the market. So that could help.
Yeah, and I think the consensus on the S&P kind of has modest additional upside from here, but not a repeat of the first half of the year, which is kind of normal because you had one of the best quarter twos in the history. So, a lot of these analysts that we follow, they kind of cherry pick their numbers like, hey, we see modest returns, but not as good as the second quarter. Well,
nobody called for the second quarter being what
Exactly.
it was either. So, I mean, again, these are all just, we know they're all unknowns. I mean, some things that could shake the rest of the year up. Obviously, the biggest one is it's a midterm election year. So there's going to be a pickup in political noise, which creates short-term volatility.
Yep.
We see it every time we're in an election cycle. It's just, it's natural, right? We're going to see a pickup in noise, and that's going to increase our short-term volatility.
Yeah, definitely. And that happens every time there's a midterm election, it seems like volatility in the market picks up. And what I try to remind the families that we work with is don't worry about the headlines. It's more about the plan that you actually have and the companies that you're actually invested in, right? If earnings are still strong, if the companies that you own are still doing well, the midterm election shouldn't matter as much to your portfolio. Now, it should, if somebody comes in and changes the tax code, well, of course that's going to have an impact on you. But for the most part, if things are staying status quo, those midterm elections shouldn't mean, as much as they do, especially when earnings are as good as they are with these companies.
Yeah, I mean, we can't let that short-term noise impact long-term decisions.
Yeah.
And when we think about that growth bucket or your money in the stock market, that is more long-term. I know we might have some draws on that, but that's why we fund the income bucket. So we can't let that short-term noise make long-term decisions for us. The other thing that could shake things up is obviously the new Fed chair, Warsh. He signaled less willingness to rescue markets. So we're going to see what he does there. Again, that decision is today, so we'll kind of see what happens.
Yeah. I mean, if you look at the last Fed chair when COVID happened, they had to basically slash interest rates. I mean, almost every quarter to kind of get the market in line.
It saved them. I mean, it really helped the market.
It really did. And that's why people saw, if anybody has an interest rate, a mortgage rate of like 2.5% or 3%, that may never happen again. But that's exactly why it did happen, is because the markets were in turmoil and they basically slashed rates for, basically a year straight.
That's why you saw a ton of people refinancing their mortgage at that time. I mean, the financing options were tremendous when interest rates are in the twos. So
and who knows what would have happened if they didn't slash rates at that time. That really helped the country recover in a lot of ways. So we'll kind of see, what they do. I mean, I'd like to think if something were happening, they would have to slash rates, but we'll see where they go from here.
Yeah, I mean, as long as inflation and everything stays kind of stagnant as where it is now, I think that's a good thing. But, heading into the second half of the year, we have some big things ahead of us. Like we have the midterm. Rates are going to stay put, maybe tick up. Inflation's kind of a steady, slow burn, but we'll see what happens there. But hopefully earnings can keep doing the heavy lifting for us and continue to drive this stock market forward.
Yeah, so I think it just comes back to when we talk about all of these different things. I know a lot of our listeners aren't as concerned about all of the ins and outs. Like these ones are these podcasts that we do on the quarter recap. They're a little more into the details. But what I would say is this is why it's so important to have a plan, because we can get into why oil impacts your portfolio and why all these things matter. But as long as you have the plan in place that makes the most sense for you, you have a tax plan, you have an income plan, your investments are invested appropriately. These things should not impact you in retirement. And that's why we wanted to talk about this. It's just so important to have that in place so that you're not making bad decisions when these things do happen.
Yeah, because we don't know what the market's going to do. We don't know what new headlines are going to come out. I mean, we believe in a couple different things. One, you have to have a plan in place. And then on your investments, you have to have diversification.
Yeah.
We want to own different asset classes. We don't want to own just one asset class. We don't want all of our money in large cap growth stocks. We don't know what the best performing asset is going to be. So I think that's an important thing.
Yeah, definitely.